1.3 Two sides to everything. There is a great difference between knowing and understanding. You can know a lot about something and not really understand it. Charles F. Kettering. There are a few key ideas underlying accounting that you need to understand. You do not need to simply memorize them, reproduce them, perhaps in an exam at university, and then forget about them. You need to understand them. You need to personally engage and connect with these ideas. You need to connect these key ideas about business that underpin accounting with your prior knowledge and previous experience. In other words, these are ideas and concepts you need to make sense of for yourself. No one else can do this for you. You must do it for yourself. This section is designed to support you to do this. Take the time to reflect on the ideas and concepts discussed in this section. Think about them and search for what they mean to you. In fact, these ideas and concepts could potentially transform the way you look at what business is all about. But before we do this, let us first look at the issue of confidence. How confident are we? Confidence and learning. We need a certain amount of confidence to learn actively, to think for myself and to make my own sense and understanding. I need to think my response and opinions matter, and that I can think about why I think something is true, and be open to discussing this and perhaps changing my mind in the light of new evidence. Here are a couple of short videos on confidence. Skill of self-confidence, over 20 million views. And if you can fake confidence, you've got it made, or at least it can be a first step to developing confidence. Body language and confidence, over 50 million views. In this unit, you will have the opportunity to learn how to focus on learning for understanding. This is your own understanding, what you think and why, rather than simply reproducing clear-cut facts from someone else. And as we start to do this, let us first look at journals and ledgers, which are the key building blocks of accounting. Journals and ledgers. Accounting uses two types of books, journals and ledgers. A journal contains the daily transactions of a firm, such as its sales to customers, purchases from suppliers, and many other types of transactions and economic events of a firm that keep happening in a constant stream each day. These are entered into a firm's journals as they occur each day. The English word journal comes from the French word jour, or day, which was derived from the original Latin word diurnalus, meaning daily. Also, since the late 1600s, the word journalist has been used for those who write for newspapers, referring originally to those who wrote for newspapers, which were published daily. So the journal is a great long list of transactions recorded as they occur each day. The ledger contains these same transactions, but arranged not in the order in which they occur each day, but in individual accounts, being various types of assets, liabilities, equity, revenue, and expenses. The word ledger means something that lies down or is laid down, having been adapted from the Dutch word logger. It originally referred to a book that usually stayed in one place because it was heavy and difficult to move, and was also constantly being used. So a ledger basically means a book lying permanently in one place. The ledgers are at the heart of a firm's accounting system. It is where a firm's key accounting information lies. In this sense, ledger now refers to the data that lies permanently in one place in our computer. Traditionally, the bookkeeper or accounting clerk enters a firm's transactions into the journals, transfers them or posts them to the ledgers, which is usually done automatically by computers these days, and looks after a firm's financial records or books up to the trial balance stage. The trial balance is a worksheet where the balances of each of the ledgers, one for each account, are listed in 2 columns, debits and credits. The total of each column in the trial balance should be the same, or in other words, should balance. It is called a trial balance because it is a tool to help detect errors in the accounts, a trial or initial attempt to balance the accounts in the ledger. This gives us an opportunity to fix up any errors that have caused the various ledger accounts to not balance. However, there are many potential data entry errors in the accounts that would not be picked up by a trial balance. For example, transposing or swapping a debit and credit entry for a transaction, or posting a journal entry to the wrong ledger account. In this way, the bookkeeper or accounting clerk would bring the books to the trial balance stage. An accountant would then prepare the financial statements using the trial balance and ledgers prepared by the bookkeeper. In the days when bookkeeping involved physical paper books, transactions were first entered into the journal and then carefully posted or transferred into the ledger. With the widespread use of computers, transactions are now entered only once. They are automatically and digitally posted in the various accounts in a firm's ledger. For example, at a Coles checkout, the sale of each item is recorded in the accounts of Coles as each item is scanned into its accounting system by the checkout operators. Indeed, the words journal and ledger are being used less and less as we no longer see bookkeeping as involving keeping a daily journal or journals of various transactions and a separate series of accounts for a range of different aspects of a firm's business. We are now recording transactions digitally into a series of accounts, and we can look at this raw data in all sorts of different ways. Nevertheless, financial records are entered into a firm's accounts based on a few key ideas and concepts, including the ideas of journals and ledgers, that influence the way we view these transactions and the economic and business realities of the firms they represent. Proprietorship. In accounting, not only do we record each transaction twice into 2 different types of books, that is, first into the journal and then into the ledger. Also, and much more importantly, we recognize that every transaction of a firm has a dual aspect. Just as a coin has 2 sides, heads and tails, or there are 2 sides to a piece of paper, or usually 2 sides to any argument. The key idea underlying double entry accounting is an awareness of a proprietor or owner of a firm who is separate and distinct from the firm itself. This is the entity concept in accounting, where the activities of a firm are kept separate from those of the firm's owners. Subsequently, this idea has been reflected in our legal system, as we have created companies that have a separate legal identity and existence to that of their owners. However, this entity concept in accounting applies to any type of firm, including sole traders and partnerships, regardless of whether the firm involved has a separate legal identity from its owners or not. The realization that a firm can be seen to be separate from the proprietors or owners of a firm introduces a duality or 2-sided nature to all transactions of a firm. This is because all transactions involving a firm will affect not only the firm itself, but also the wealth or interests of the firm's proprietors or owners as well. This is true of every transaction or economic event affecting a firm. That's right, every single one. Double entry accounting simply reflects this view or way of looking at business reality. As we will see, for every transaction of a firm, there will always be two opposite and equal components, the heads and tails of every transaction, if you like. These two sides or aspects to every transaction are called debits and credits. The word debit comes from the Latin word debere, which means to owe. Indeed, the related Latin word debitum means debt. The word credit comes from the Latin word credere, which means to believe or to entrust. The practice developed to put debits on the left-hand side and credits on the right-hand side of a ledger account. For all their capacity today, computers still have no idea about their left or right. For this reason, computers use positive numbers for debits and negative numbers for credits. As we include items in our various ledger accounts, we do not refer to increasing or decreasing an account. Rather, we refer to debiting or crediting an account, which will each result in either increases or decreases in accounts depending on the type of account being debited or credited. The underlying duality of transactions because of the proprietorship or entity concept can be seen when we debit an asset account to record an increase in an asset of a firm. We debit an asset account because when a firm receives an asset, it owes an obligation to its equity owners to manage that asset well and provide a return on it for their benefit. This is a firm's obligation to its owners. It is what it owes its equity owners. There is, in the sense that a firm is obligated to its owners for its assets, which it must have gained from them. Also, when we increase either an equity or liability account, we credit the equity or liability account. We do this because equity investors, or in the case of liabilities, debt investors, have entrusted a firm with something of value to them. They have only done this because they believe in the firm. Trust underpins all of business. We saw the importance of this in the global financial crisis, GFC, in 2008. When banks stopped trusting each other because they could not assess the risks in each other's businesses, they stopped lending to each other. For this reason, the whole financial and economic system seriously faltered, affecting billions of people worldwide, including you and me. Double entry accounting is based on the mutual obligations that exist between a firm and those who entrust resources to the firm, principally its equity owners. In this way, each transaction has two sides to it, a duality, a balance. Indeed, a trust relationship that underpins all of business. For trust to exist in business, we need someone to trust, who will be obligated to us in equal measure to our trust. An effect of this duality of all transactions will be that there will always be an equilibrium or balance between these two aspects of debits and credits of every transaction or economic event of a firm. Accounting equation. The idea that the equity owners of firms are separate to the firm itself is expressed in the fundamental accounting equation that we will see underpins accounting. Equity equals assets less liabilities. What this relationship means is that if the assets of a firm are increased, then the equity interests of the owners of a firm are also increased. And if the liabilities of a firm are increased, the equity interests of the owners of a firm are reduced. Or more precisely, if the difference between a firm's assets and liabilities are increased, then the equity interests of the owners of a firm are increased. And if they are decreased, the equity interests of the owners of a firm are decreased. This is simply a model or way of viewing the world of business. It is a simplification of all the complexity and diversity of business. This fundamental accounting equation is often expressed as assets equals equity plus liabilities. We have seen the idea of proprietorship and of a firm being a separate entity to its owners leads to all transactions of a firm having two aspects to them. This duality has the effect of preserving the fundamental accounting equation throughout a firm's accounts. The way of looking at transactions or other economic events of firms is consistent with the business model or way of viewing business reality embedded in the discipline of accounting. This business model is neatly summarized and expressed as the fundamental accounting equation. In this way, as we record transactions and other economic events in the accounts of a firm, each will fit neatly into and support our overall business model or view of the firm. Double entry accounting is not a method simply designed as a check on the mechanical accuracy of the entry of transactions into a firm's accounts. That is a commonly held misconception about accounting. Rather, the ability to use the fact that the debits and credits of a firm's transactions should always balance to check the accuracy of data entry into a firm's accounts is a byproduct of double entry accounting, not the reason for it. Instead, double entry accounting is a way of looking at business. As it has turned out, it is a very powerful way of looking at business reality. Indeed, the ideas and concepts of accounting have become so pervasive and central to the way we understand business for centuries, right up to the 21st century. And though you may not yet know this, it is the reason why you are finding yourself studying accounting and reading this study guide today. We can see that, at its heart, double entry accounting is a way of looking at business. It is a way of perceiving and making sense of the economic and business realities of firms. A key idea underlying this view of business is that the owners of a firm are completely distinct and separate from the firm they own. This means a firm is debited with assets because it owes an obligation to its equity investors for all the assets it controls, and which are the means of generating future value to repay that obligation. It also means a firm is credited with equity and liabilities because someone outside the firm has entrusted the firm with resources, believing the firm will repay them in the future. In this section, we've seen there are two key books in accounting, namely journals and ledgers, and that in our digital age, these two separate set of books rarely exist. We have also seen the key ideas of proprietorship and of the fundamental accounting equation that together underpin accounting. These central ideas of accounting reflect a way of viewing the economic and business realities of firms. In turn, this view of reality underpins the way transactions are recorded in a firm's accounts. Accounting records and measures the economic and business realities of a firm in a way that reflects a view of business. It is a powerful way of viewing business, but is not the only way we can view business. Understanding accounting can be a powerful way to transform the way we see and think about the day-to-day realities of business. This is possibly why so many people who end up running our businesses as chief executive officers, as other senior managers or as directors, know at least something about accounting. 1.4. 5 elements of accounting. It is a little known fact that truth cannot be memorized. Barry Long. The key ideas underlying accounting of proprietorship and the entity concept of a firm leads us to view a firm as having 5 elements: assets, liabilities, equity, revenue, and expenses. Assets are a present economic resource controlled by a firm that has the potential to produce economic benefits. that is, has the potential to add value to a firm in the future. For example, Coffee Supreme, a coffee business based in Wellington in New Zealand with operations in New Zealand, Australia and Japan, owns several small delivery vans. These delivery vans are assets because they have the potential to produce economic benefits to Coffee Supreme by transporting its products to customers, who are mainly coffee shops, in the future. Liabilities are a present obligation of a firm to transfer an economic resource that a firm has no practical ability to avoid. For example, Coffee Supreme may have promised to pay $50,000 in 2 months to a firm in Brazil that has recently supplied it with raw coffee beans. This is a liability because it is a present obligation that will involve transferring $50,000, an economic resource, out of Coffee Supreme's bank account that it has no practical ability to avoid. Equity is often referred to as a leftover concept. What is left over for the owners of a firm after liabilities are deducted from assets? However, the concept of equity is grounded in the concept of proprietorship and of a firm being a separate entity to its owners. It is the other side of the coin to a firm's assets and liabilities. Assets and liabilities represent the value of a firm. Equity represents the value of the interest of its owners in the firm. Based on our view of business reality underlying accounting, equity will always equal assets less liabilities, as summarised and expressed in our fundamental accounting equation. It is because equity does have its own separate conceptual reality in the way we view business in accounting that all transactions of a firm conceptually have a dual nature, affecting both its equity and its assets and liabilities. Measure of value. Assets, liabilities and equity are the 3 elements that provide a measure of the value of a firm and of the interests of its equity owners, or in other words, the financial position of a firm and of its equity owners at a given point in time. Value is a central concept in all our lives, and we have a wide range of opinions and views about what is important or valuable or worthwhile in life. So accounting enters right into this issue of what we value in business. Indeed, accounting seeks to put a precise dollar figure on the value of a firm, or at least to give us information to help us make our own estimates or judgments of value. This is useful in business, well, essential, because all firms transact with others in markets using dollars to measure the value being exchanged. Firms transact in product markets with customers, in input markets with suppliers, and in capital markets with equity and debt investors. All exchanges of value between a firm and other participants in these markets are made in precise dollar terms. For this reason, quantifying value into hard, harsh monetary terms is unavoidable in our market-based economy. The view of the value of a firm in a firm's accounts is built up from each one of the transactions and other economic events recorded in its accounts. This is where the value of a firm as expressed in its assets and liabilities, and the value of the interests of a firm's equity investors as expressed in its equity, comes from. It does not come from anywhere else. Changes in value. A firm's value is changing day by day and moment by moment because of its business activities and of changes in the markets in which it operates and in the world around it. As anyone who's been involved in business knows, firms never stay still. Business is always on the move. The realities of business are always shifting and changing and affecting the value of a firm and the value of the interests of its equity investors at different points in time. The value of a firm, as expressed and measured by a firm's assets and liabilities, is constantly on the move and changing. In the dual nature of our view of business reality, the value of the interests of equity investors in a firm is also constantly changing. Revenue and expenses. Now we come to something important about the way we view business reality in accounting. We usually do not keep adjusting our firm's equity day by day or moment by moment for changes in the value of a firm. Instead, what we do is have temporary accounts of revenue and expenses to hold the various additions or reductions in our equity. Every so often, perhaps monthly, 6 monthly or yearly, we empty out these temporary revenue and expenses accounts and calculate the net effect of our firm's transactions for a period on the value of the interests of our equity investors in a firm. We call this a firm's profit if there is an increase in value and a loss if there is a decrease in value. We transfer this profit or loss to a firm's equity at the end of a period. We then start the next period with zero amounts in our revenue and expenses accounts. Revenue are increases in assets or decreases in liabilities of a firm that result in increases in equity, other than those relating to contributions from equity investors. For example, revenue would include sales by Coffee Supreme of fresh roasted coffee to Daymade, a cafe in Woolloongabba in Brisbane, near the Gabba Stadium. If Daymade Cafe paid for this coffee in cash, then this would increase an asset, that is cash, of Coffee Supreme by the same amount. Revenue would not include an increase in cash, an asset, if shareholders in Coffee Supreme paid cash to the company to buy new shares in the company. Rather, in such a case, equity would be changed immediately. Expenses are decreases in assets or increases in liabilities of a firm that result in decreases in equity, other than those relating to distributions to equity investors. For example, expenses would include the cost of electricity used to power the coffee grinders and roasters in Coffee Supreme's manufacturing operations in Hopper Street, Wellington. Expenses would not include a reduction in cash, an asset, because of Coffee Supreme paying a dividend to its shareholders. Revenue and expenses relate to something the firm has done to create or destroy value during a period. The reason we do not include transactions between a firm and its equity investors as revenue or expenses is because these transactions transfer value between the equity investors and the firm. They do not create or destroy value for equity investors. For example, if equity investors buy new shares in a company, they will pay the firm some cash, increasing the value of the interests of equity investors in the firm and reducing their own personal cash by the same amount. If a company pays its equity investors a dividend on their shares, the firm will pay some cash to its equity investors, decreasing the value of the interests of equity investors in the firm and increasing their personal cash by the same amount. As a rule, you cannot create value by simply moving things around from one pocket to the next. Life and business is meant to be easy, but not that easy. Revenue increases the value of the interests of our equity investors in a firm, that is, increases a firm's equity, and expenses reduce the value of the interests of our equity investors in a firm, that is, reduces a firm's equity. If a firm's revenue is greater than its expenses during a period, the firm has added, or perhaps magically created, value for its equity investors. If a firm's expenses are greater than its revenue during a period, then the firm has reduced, or perhaps less magically destroyed, value for its equity investors. Extended accounting equation. The relationship of the 5 elements of accounting can be viewed as assets equals equity plus revenue minus expenses plus liabilities. Or if we add expenses to each side, assets plus expenses equals equity plus revenue plus liabilities. This is often called the extended fundamental accounting equation because it includes changes in value over a period, revenue and expenses, as well as measures of value at a point in time, assets, equity and liabilities. Understanding the extended fundamental accounting equation is essential to understanding what accounting is about. It is also a necessary first step in our journey to being able to potentially use accounting information to help us connect to the economic and business realities of firms. In this section, we've looked at the 5 elements of accounting: assets, liabilities, equity, revenue, and expenses. These 5 elements or ideas underpin the view of business that accounting can give us. Accounting captures those aspects of a firm that will support this view of business reality. A key part of this view of reality are precise dollar measures of value at points in time, assets, liabilities and equity, and precise dollar measures of changes in value during periods of time, revenue and expenses. Conclusion. In this chapter, we've seen that a firm's accounts are not themselves the economic and business realities of firms. Each firm experiences its own economic and business realities quite independently of what gets recorded in its accounts. Accounting involves recording in a firm's accounts some aspects of what is going on in a firm. The way this is done has developed over many centuries. Embedded in the approach used in accounting is a view of business reality. Over time, this view of reality has proved to be a powerful one. It has resulted in a profession of accounting that has an insatiable appetite for university graduates from around the world, in many ways regardless of where we are in the economic cycle. It has also resulted in many of those in senior management and board positions of firms having backgrounds in accounting. In the next chapter, we'll see that when firms provide their accounting information to people generally outside their firm, there are a lot of rules with which they need to comply. Yes, a lot of rules. We'll now have a look at understanding the rules of this game called accounting.